I'm really interested in the fact that you've got holdings in Nvidia, you're clearly a supporter of the AI theory, but are we looking at a bubble and then you get these sorts of deals?
Well, you've got to look at it two ways. One, in terms of the timing of the deals. If it is a bubble, it's potentially an NPV issue. Are we going to get all this revenue in 10 years' time or 5 years' time? And that's what the market is trying to figure out right now. People try to compare this to the dot-com bubble, etc., but there's a difference here. A lot of the companies who are buying a lot of these products are supported by strong cash flows, free cash flows, which means that there is potential for these revenues to come through, especially if AI demand take-up goes along the lines of what we're seeing in the last 2-3 years.
I mean, none more so have the financial flex than Nvidia.
Yep.
And it's interesting that Nvidia, when signing that 10 gigawatt compute capacity with OpenAI, did give $100 billion in terms of support buying equity. Is those sort of circular financing deals something that gives you pause, or do you think that that's part of what the deal needs to be?
No, that does give us pause. You do look at that and say, hang on, this is not clear blue sky. There are some things we need to think of. So that's why the next 2-3 years are going to be really important. Because what we want to see is the return on the capex that companies like Alphabet, Meta, a lot of these big companies are spending to show up. If it shows up, then what you realize is that this $100 billion is not circular, but just the Kickstarter. So that's what we want to try to see.
I mean, you own Meta, and Meta has shown up in terms of generative AI being folded into the advertising model, being able to be built in and bring real revenue to bear right here, right now. But how long are you going to have to wait for Alphabet's bet to really pay off? We already see in Nvidia, but do you think more broadly OpenAI eventually really showing that productivity is going to gain them in terms of revenue?
So from an Alphabet, from the software company's perspective, we do think that the next 12 months are going to be really important. What you do need to see is not just the return on capex going through, but the revenue growth coming through to support that. In 27, 28, that we are going to see a continued acceleration or at least stability in revenue growth. Without that, it's very hard to see how the market gets really comfortable with the amount of capex that's being spent right now.
I mean, you just said it does give you pause, and there isn't just blue sky when it comes to Nvidia. So have you just been trimming some of the exposure? Has now been the time to just stay holding pat and not adding to some of the overall portfolio exposure to some of these names?
So we tend to think of in terms of longer term. So what does this look like in the next 5 years? When we look at it from that perspective, the valuation doesn't look extreme at this point in time. It does look at give us a pause in terms of, look, what else do we need to factor in to keep buying more? But at the same time, it doesn't give us any fear that, hey, this is an imminent bubble, as you asked at the start.
Well, on Friday, there was a lot of pause between US and China, and particularly access for some of these companies to rare earths that ultimately are very dependent on China. How much have you been baking that into a supply chain headache for some of the companies you own?
So that's, again, it's a timing issue. So there's two parts. The first part is this become a prolonged issue, geopolitical issue? Then there's a lot of other things that you need to think of, not just the semiconductor companies, but all the FMCG companies, all the other companies that sell into emerging markets and all global trade. So let's set that aside, that this is a solvable problem that gets solved at some point in the time. Then it's a timing issue. Already what the companies are telling us is there's a real supply issue, that they don't have enough computing power. So that means that people who make these chips benefit from any of these supply chain issues, because to them, they get pricing power in the short term. But in the longer term, this gets solved, so it's a temporary issue. So if anything, these sort of market dips is an opportunity that you look at saying, what are the good quality companies that you do know have pricing power that you want to buy into right now?
And what are they, if it's not the obvious AI winners and darlings we've already seen hit $1 trillion?
No, they still remain, as I said, they still remain attractive. But there's a broader spectrum out there. If you look at companies like Delta Electronics, which provides electronics cooling equipment to data centers. You look at Schneider. You look at SAP, which is going to benefit from the fact that AI gets taken up by more and more enterprises. So there's a bigger ecosystem than just the semiconductor companies or just the cloud companies.
As increased rivalry in the AI hardware market and fresh trade tensions between the United States and China affected investor mood, Nvidia's stock fell on Tuesday. In morning trade, the stock dropped around 4% to $181, reversing some of Monday's nearly 3% rise. The retraction stoked worries that trade relations between the two biggest economies in the world would deteriorate after China's transport ministry announced it was examining a U.S. investigation into Chinese shipping companies. Peers in the semiconductor industry also pulled down, with Broadcom falling by about 3%. As investors evaluated new competitors in the high-performance AI business, pressure mounted on the larger semiconductor industry. after Broadcom announced a 10-gigawatt AI accelerator relationship with OpenAI, which mirrored a similar arrangement Nvidia made last month to provide infrastructure for the business. Attention turned to the company. According to analysts, the development underscores the growing competition for processing capacity between big cloud providers and chip makers, including Alphabet's Google and Meta platforms. Additionally, Nvidia unveiled the DGX Spark, a small AI supercomputer designed for programmers creating local AI agents. With the product, Nvidia can now operate in smaller settings outside of data centers. Despite the drop, analysts believe the setback is only transitory because Nvidia's dominating software platform and robust developer community still support its long-term growth prospects. Analysts are still optimistic about Nvidia's long-term prospects despite Tuesday's decline. Citing persistently strong demand and limited supply across Nvidia's product lines, Piper Sandler reaffirmed its overweight rating and $220 price target. The company pointed out that Nvidia's finance arrangements with important clients like OpenAI and CoreWeave are still solid and unaffected by the circular financing problems that other tech companies are facing. However, Piper Sandler also admitted that government pressure on local clients continues to limit Nvidia's sales in China. The company pointed out that although some export licenses have been issued, there are still restrictions on operations in the area. After discussions with the company's management, Cantor Fitzgerald maintained its overweight rating and increased its price objective for Nvidia from $240 to $300 last week. According to the brokerage, hyperscalers are showing significant long-term demand visibility that may be worth hundreds of billions of dollars over the next several years, indicating that the continued development of AI infrastructure is still in its early phases. Cantor Fitzgerald, who predicted earnings per share of $8 in 2026 and $11 in 2027, both much above than the market consensus, expressed increasing confidence in Nvidia's growth trajectory. If artificial intelligence is a bubble, Nvidia is at its core. The company is the king of AI. The business can anticipate strong profits as long as there is a growing need for AI. It announced net profits of $26.4 billion for Q2 2026 on August 27th, up 59% from $16.6 billion for Q2 2025. Highlights of Nvidia's earnings. Revenue increased by 56% to $46.7 billion annually. Gross margin of 72.4% as opposed to Q2 FY 2025's 75.1%. Earnings per share were diluted to $1 from $0.67 in the second quarter of FY 2025. Nvidia's forecast for the third quarter of fiscal year 2026, an estimated $54.0 billion in revenue, give or take 2%, is anticipated. A gross margin of 73.3%, plus or minus 50 basis points, is anticipated. The company's outlook does not include any H20 sales to China. Recently, the notion that we are living in an AI bubble has received a lot of media attention. Let's check with the professionals. In an August interview with The Verge, Sam Altman, the CEO of OpenAI, acknowledged that he believes we are living in an AI bubble. The internet was quite significant. People became overly enthusiastic. Are we in an era where investors are overly enthusiastic about artificial intelligence? Yes, in my view. In an interview, Mark Zuckerberg discussed his thoughts on the potential AI bubble. Based on previous massive infrastructure build-outs and how they caused bubbles, I do believe that there is a real chance that something similar would occur here, at least empirically. Jeff Bezos, the founder of Amazon, has also talked about the AI bubble lately. Bezos views the current situation as an industrial bubble that is more akin to the biotech bubble of the 1990s. We did get a couple of life-saving drugs, Tony Owusu of The Street noted, despite the fact that many investors lost a lot of money in that boom. In a recent research, Will Sommer, a senior director analyst at Gartner, shared his opinion. The underlying product, agentic AI, is sound at this point, and the current market correction, where markets rationalize and consolidate, is a normal part of the product lifecycle. This makes the upcoming agentic AI market correction different from speculative bubbles driven by systemic financial engineering, fraud, or policy. Sommer went on, a speculative bubble might still develop nevertheless if investment moves away from agentic AI's inherent capacity to produce real and proportionate economic benefit. In an interview with CNBC's Squawk Box, former Intel CEO Pat Gelsinger talked about the AI bubble and asked, "Are we in an AI bubble?" "Of course. I don't see it ending for several years," he continued. Last but not least, Jensen Huang, the CEO of Nvidia, stated on Squawk Box that AI differs from the dot-com bubble. However, there is a significant difference between what happened in 2000 and what is happening today. Vivek Arya and his team of analysts at Bank of America revised their assessment of Nvidia shares in response to what they called AI apocalypse stories. It is challenging to match capacity to future demand, and there is frequently a technological race to create new revenue streams or fortify current moats, according to analysts, who also noted that large-scale infrastructure rollouts necessarily involve some risk of overbuilding. 4 significant distinctions between the current AI build and the previous dot-com crash were identified by BOE analysts. The underutilized dark fiber of the dot-com bust is not the same as high utilization of AI computing capacity. Unlike debt-driven financing during the dot-com era, the leading cloud service providers' capital expenditure plans are on schedule. In contrast to previous market collapses that occurred while interest rates were rising, the U.S. Fed is more likely to decrease rates than raise them. The price-to-earnings ratios of over 100 dot-com giants, including Cisco, Nortel, and Yahoo, diverge from Nvidia's value. According to the researchers, space, water, and power constraints will probably prevent data centers from being overbuilt. For AI suppliers, smartphone RF, and connectivity chips, they believe that the direct relative risk from U.S. China tariff tensions is the lowest, at less than 10%. This stands in contrast to other tech industries, including the medium-risk analog vendors and the high-risk ones, which include intellectual property, semiconductor capital equipment providers, and electronic design automation. Nvidia's negative risk indicators were identified by analysts: weakness in the market for consumer-driven gaming, competition from large publicly traded companies, impact of limitations on compute shipments to China that is greater than anticipated. Sales in the data center, auto, and new enterprise sectors are erratic and lumpy. The possibility of slower capital returns. Increased government examination of Nvidia's hegemonic position in the AI chip market based on 37 times his estimate of the price-to-earnings ratio. Arya reaffirmed his buy recommendation and the $235 target price. This does not include cash for 2026, which falls between 25 and 56, Nvidia's historical forward-year price-to-earnings range. He said that Nvidia's dominant position in the rapidly expanding AI compute and networking industries justifies the multiple, which is counterbalanced by the cyclical nature of the gaming industry, lumpiness in global AI projects, and worries about power availability. The field of artificial intelligence, AI, is expanding quickly. Businesses are spending billions on developing the infrastructure required to support the myriad AI applications that include generative AI, machine learning, large language models, LLM, autonomous systems, and more. The worldwide AI market was valued at $279.2 billion last year and is expected to reach over $3.5 trillion by 2033, according to Grandview Research. That represents an astounding 31.5% compound annual growth rate. Additionally, Nvidia CEO Jensen Huang brings out a problem that is frequently disregarded, even if AI is the all-consuming metaphorical beast. He told CNBC that everyone wants to use the AIs because they are so intelligent. 2 exponentials are now occurring simultaneously. In reference to Nvidia's most recent GPUs, he stated, "Blackwell is really high demand. I believe that a new industrial revolution and a new build-out are about to begin." It's a fascinating point. How are we going to provide the power needed for this enormous rise in AI workloads? AI needs a lot of energy to run the data centers, which are brimming with potent computer technology, as well as to provide the cooling capabilities necessary to prevent the centers from burning out. AI development will inevitably stall if there is nowhere to rack graphics processing units, GPUs, power them, and cool them. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
And what do you make of what we're seeing out there in the market today? I was just having a good chat with Peter Anderson, who isn't giving credence just to this U.S. China sort of re-escalation with China cracking down on ships. It's also a few questions out there, perhaps around the whole AI monetization story as well. Is that what you're seeing out there?
You know, I would kind of side with that. You know, my weekly blog that I did last week, I was just really talking about, you know, how we saw this outsized, you know, down near 3% move in the S&P 500 on the, you know, the Trump tweet, which was elicited by a lot of the restrictions that China had imposed. And look, I'll acknowledge, you know, first, number one, in this trade relationship with the world, China is number one. It's the most important. But number two, it was the setup going into that announcement, because prior to that, you know, the markets really didn't care about trade. They didn't care about new tariffs. We're not going to react. We're not going to bite unless we actually see it show up in the data. But it was enough of an excuse, I feel like, to get some of this liquidation from this froth, this excess that's been going on. We know that the spec Momo cohort has been working for a while. But Sam, we talked last week, you know, so when I look at this price action here, we talked last week about the Philly Semiconductor Index and how I mentioned that the RSI went up to a 14-year high. It hit like 84, 85. And that we really couldn't tell at the index level what was going on underneath the surface, meaning all of the big movements we see from the non-profitable, low-quality tech, anything that has an announcement type of move. And so it looks like a little bit of that got rattled. You rattle the confidence of those Momo traders when you do something like Friday's price action. Secondly, you know, if we respect this uptrend that we've seen in the S&P 500 since April, we have not had 2 consecutive day closes below the 20-day simple moving average. Yesterday is the first time we got number 2. It looks like today we'll get number 3. So why do I bring this up? Just from a near-term trading perspective, for those that are active out there participating in a lot of these big moves that we see every day, I think with the stocks at the index level, 14-year RSI, you get an orange flag. Now it looks like 3 days closed below the 20-day SMA orange flag. You look at some of these announcements that are coming out, and they're coming out, you know, daily or a couple times a week, whether it's AMD and Oracle, whether it's Broadcom and OpenAI, et cetera, but the punch, the reward for these types of announcements, A&D is up, you know, $1.50 on this news here. When you start to see some deterioration where maybe you don't get that much of a positive response, maybe you don't reward the dip buyers as often or as frequently, these are some of the early signs which you could see a near-term shift in sentiment or trend. It doesn't necessarily mean down, but it means, hey, maybe you could be a little bit cautious, pull some exposure. We could be going through some chop here for the next couple of weeks.
Okay, so we had the earnings starting in earnest today with the big banks reporting. I mean, looking pretty good as far as what they've been saying, although we are seeing a bit of a mixed performance as far as the share price is concerned. I mean, everybody's been talking about how the earnings is going to be sort of the next catalyst now, you know, obviously in the absence of the data, with the big question marks still around Fed policy and also the tariff question as well. What do you make of what we're seeing, hearing from the banks and the reaction in the market today?
You know, I'd say so far so good. You know, Sam, if you look historically, the financials, yes, very important economic barometer. The results look pretty good to me across the board in terms of being firm. The price action, it's not uncommon to see, you know, financials sell off or have a mixed response or a muted response post earnings. So it's a bit early. Let's get into some more of the cyclicals, and then we'll get into mega cap tech here in a couple of weeks. And it's not just what mega cap tech and that AI, you know, adjacent type tech plays report, but it really is that price action. That will tell us whether we're priced in or not. I would say more importantly, near term, what I'm keeping my eye on is the bond market here. Sam, I think that we've got the conjunction of now we have a fundamental kind of a uncertainty that is building a little bit. Number one, around China-U.S. trade. Number two, around the government shutdown. And then number three, what I'd point to is the yields on the 10-year, which is getting ever so close to that 4% level. I think if we breach 4%, Normally, we think lower yields are better for the market, but if you look at what the IMF said today about potentially we haven't seen the effects of tariffs, then you look at China escalating the trade relationship with the U.S. today. So it's going in the wrong direction. If you get 10-year yields to breach that 4% level, I think that could bring in some more volatility and potentially we can get a bigger pullback here in a couple of weeks. So near term, that's what I've got my eyes on. Of course, earnings are important. They're going to give us a read-through in terms of where we stand on this rally, in terms of whether we're priced in. But if you look at the estimates, they look healthy. FactSet looking for 13% next year. We'll keep an eye on those estimates and see how they fluctuate as we begin to get more of that economic data that comes in.
Without a 3% sell-off, that explains, I think, why everybody's so nervous.
It is. It kind of feels like it's just like an earthquake or a volcano where the pressure's building and building and we're not seeing any of these small corrections. I don't think it's that bad. This is just a normal bull market. This type of low volatility tends to happen when we're seeing the run like this. We've seen it in 2016. We saw it in 2020. We see it now coming off of the tariff tantrum. Now, remember, we packed a lot of vol into 3 days in that tariff tantrum there.
Yes.
So maybe we kind of front-loaded the vol. But I also look at this and I say this is just a normal bull market. If you look how bull markets run, I get it's been extremely low volatility. Nobody'd be surprised if some other tweet sends us down 2 to 3%. But to me, this is just normal. I know it feels abnormal, and yeah, maybe we've had a little less downside.
6 months, normally sell-offs happen 1 to 2 months, going back to World War II. That's a pretty long timeline. We haven't had a meaningful sell-off in 6 months. It's noteworthy.
It is. But
does it mean anything? I don't know, but it's noteworthy.
Well, I don't think the sky is falling. I think this is almost a little bit of, if you look at statistics and data hard enough, it'll tell you anything. And so I look at this and say, well, what's the catalyst behind it? What's the reasoning behind it? I think this bull market has 4 really strong legs to stand on. Number 1 is seasonal. Fourth quarter is great. November's the strongest month of the year. You're coming in here with a great setup. Number 2, technicals are very, very strong in the long term. Yes, near term overbought, but general technicals are very strong. 3, fundamentals, earnings growth, driving us forward, driving us faster. And then number 4 is historical. Historic bull markets, you get to this point, usually last 5-6 years. We're 3 years into it, now off the 22 lows. We still have a ways to go. You have a 4-legged stool for this bull market to keep rallying off of.